When you think about how the market has sort of assessed these economic data points and their assumption that at some point this is going to push the Fed to cut, do you think that's realistic?
Well, yeah, the Fed at some stage is likely to cut. The macroeconomic outlook is kind of mixed. It's interesting. If you look at PMI, Purchasing Managers Index, it's in the worst quartile historically. If you look at inventories, they're in the highest quartile ever. If you look at the slope of the yield curve, which is a terrific predictor of slowdowns, it's in its worst decile ever. If you look at rate of change of the cost of capital, which is a gauge that helps us understand whether companies are going to invest in new initiatives, that's in its worst decile ever. So with 4 out of 4 looking troubled, why is this economy chugging ahead? It's all on the back of a wealth effect from a bull market plus consumer spending. And so my question is, will those 4 indicators of slowdown have time to turn before consumer spending slows or before the market rolls over? The jury's out on that. I don't know.
Well, let me flip that on its head, though. Do you think the Fed will, be able to turn fast enough to maybe avert that? Or are we kind of past that Rubicon already?
We often hear that monetary policy has long and variable lags. What does that mean? That means that the impact of monetary policy on the macroeconomy is slow, and we don't know how slow. It can take a year, it can take 2 years. When you say slow and variable lags, another way to interpret that is maybe there's no impact anyway.
Well, that's what I was going to say. No, Rob, that's what I was going to ask. 25 basis point cut, what does that actually do?
It's not clear to me it does anything other than perk up enthusiasm, create a little bit of liquidity that often makes its way into the markets. And I don't think the Fed has the power to stimulate the economy. I think the Fed has power to stimulate bubbles, but not to stimulate the economy. So is the Fed going to cut rates? I think they urgently want to cut rates as soon as they have the economic cover to do so. A softening economy may give them cover to do so sooner rather than later. But if inflation surges back, which seems very possible, the commodities indexes have soared in the last 6 months. If inflation does reignite, then they can't cut. If the economy remains robust, then they can't cut. So they want to cut, but they're just not being given cover to do so.
Rob, do you feel like there could be an offside risk that there's a hike in our future?
Absolutely. I would characterize the current outlook as not quite symmetric, more likely to see cuts than increases. But, if inflation does come roaring back, between now and year end, we are replacing months that were very benign last year. Every month, we wait with bated breath for the new inflation report. And the new inflation report exactly equals last month's inflation report plus 1 new month minus 1 old month. Now, that plus 1 new month, we don't know what it's going to look like. The minus 1 old month, we know exactly what it was. And if it was low, abnormally low inflation during the latter months of last year, then upward pressure is more likely. Upward pressure on inflation is more likely than downward. So we're of the view that 3.5 to 5 is the likely end of year inflation number. 3.5's not going to bother anyone. 4 to 5 is going to be seen as a real blow and would keep the Fed from cutting and might encourage them to hike again.